In today's video, I would like to cover the topic on the options. I'm looking at this from a beginner perspective so that anyone without any background can also follow this topic. So let's start from the basic first. Let's look at the definition of options. An option is a contract that gives the owner the right but not the obligation to buy or sell a security at a particular price on or before a certain date. So you see this, right? If you have a right but not the obligations, it means that the payoff could only be positive. For example, if the payoff is negative but you don't have the obligations to exercise, then you can just let the options to expire. Investors buy and sell options just like stocks. So there are basically two basic types of options. First one is call options and second is put option. The call options is the right to buy the underlying security, whereas for the put options is the right to sell the underlying security. As we move on to more complicated options, right, they usually are based on these two types of options. Next, let's understand what is the intrinsic value. If we look at the options, there's a value or a price that is associated for the options. The option value is composed of two components. So the first component is known as intrinsic value. Second one is called the extrinsic value. The intrinsic value is the amount of money that the option would be worth if it expired today. So let's take an example here. In this example, we are looking at call options. So let's say the stock price is 175, the strike price is 165. It means that at the maturity, if we want to exercise the options, we are going to pay 165 in order to acquire the underlying stock. If we look at this example, right, the options value is $38. So how do we calculate the intrinsic value? First, we just take the 175, which is the stock price, minus 165 and we get $10. What it means that if the options expire today, we pay 165 to acquire something that is worth 175. So the difference, right, which is $10, this is called intrinsic value. And if we take the option value 38, subtracted the intrinsic value, then we get the extrinsic value, which is 28 here. So the options must be in the money to have intrinsic value. The definition of in the money is that for call options, if the stock price is above the strike price, we call it as in the money. If it is the same, we call it at the money. And if it is below the strike price, then it is known as out of the money. For put option, it is in an opposite direction. So the stock price has to be below the strike price in order to be in the money, and if it is above the strike price, it is known as out of money. So just now I mentioned that there are only two types of basic options, right? One is call options, one is put options. The diagram that I'm showing here, this is known as the payoff diagram. So let's look at the first one. If we buy a call options, the dot here represents the strike price. So as the share price goes up, it is beneficial for the owner of the options to exercise the options. Hence, we have a payoff that is going up. But what if the price fall below the strike price, which is the region on the left here? So because we don't have the obligations to exercise, we can just let the option expire. So it is capped at the level here. Okay. So for put options, it is the opposite. If the share price goes down and we have the rights to sell the underlying at a specific price, meaning that we will have a positive payoff if the price fall. So that's why we have the payoff pattern, something like this here. That's the payoff diagram for buying call and buying put options. For options, it is a contract between two parties. So whenever there is someone that buy the options, there will be another person or another party that is selling the options. If you look at this one, the sell call, this is your counterparty, basically the counterparty for the person who bought the call options. Hence, you can see that the payoff diagram is like a mirror image of the buying call here. And similarly, for the person who sell the put, it is the mirror image of the buying put. So let's get into more details here and pay attention to how we construct the payoff diagram. Just now I mentioned that above the strike price, we will have a positive payoff, and then below the strike price, we will have a payoff that is capped to certain level. But why this line here is not here? It is a bit below here. So let's look at the details. This is the strike price. So if we ignore the fact that we have to pay the premium in order to own the options, the payoff is this yellow line here. If the price goes up, we have a positive payoff. If the price stay or fall below the strike price, then the payoff is just zero. This region, it just means that we let the option expire. The reason that this payoff diagram is below the yellow line here is because we have to pay a value which is known as the option premium in order for us to acquire the right. And in the next slide, I would explain more in terms of how we value the options. I won't go into very details in terms of the technical, but we will just focus on the basic first. So the method or the formula that we use to price the options is known as Black-Scholes model. So the full name is Black-Scholes-Merton. And then if we look at the key takeaways here, basically it is a differential equation used to solve for the options prices. So this is a very popular or very sophisticated model that is invented, I think, in 1970s, if not mistaken. And right now, people are using this formula to determine what is the theoretical price of the options. Of course, this is just a model, and models will depend on the parameters in order to derive the valuation, and the parameters basically set by the market. Okay, just now I mentioned that we need the parameters in order to be input into the formula to calculate the options. And what are those input? We'll go through each of them here. And in order to illustrate, I'm using the interactive broker interface here just to show you how you can look up for the parameters. Okay, the first one is the option price, which is shown in this entire column here. And then the second one is the spot price. Spot price is basically the price of the underlying or the stock that we are interested at. The third one is the strike price. So strike price is the price that we choose to say, okay, we are going to pay this strike price when we exercise the options. I will skip the risk-free rate because usually risk-free are fairly constant. The next one will be the time to maturity, meaning that when the options will expire. And you can see here, this is just one example. I'm looking at options that is very long here, 769 days. Usually options that are very liquid are those that are shorter, for example, like within 1 to 3 months. Lastly, is the volatility of the assets. So this one is really depends on the stocks. For example, stocks like Tesla usually will have a very high volatility, and hence the volatility numbers here will be much higher. Other stocks, for example, like Microsoft, which has lower historical volatility, their volatility that is used to price the option is also lower. So in order to calculate the options value, basically you just need to take all these parameters and then just plug into the formula, and that's it, you can get the options value. So I think it would be helpful if I give a diagram here just to help you understand how option valuation works. So this is the price of Walt Disney Company. The stock price will fluctuate around, and let's say it stopped here, and currently the price is at $176. It just spiked up recently because of the good news from the streaming business. So if we look at the price of the stocks, right, at current point, if we project forward, it could move up, or it could stay constant, or it could come down. Okay, so these are the potential prices at a specific date. Let's say we are looking at March 2021. So basically there is a distribution, something that looks like a normal distribution here with different potential price in the future. So in this example, let's look at if we set a strike price of 150 for a call options, what is the payoff of that options if it end at different price level? So let's say the price as of March 2021 is 210, and because the strike price is 150, for sure we will exercise the options, right? And the payoff will be 60 because we are going to pay 150 and we get something that is worth 210, so the payoff is 60. And then if the price is 200, the payoff is 50, and so on. But if the price is 150 or below, the payoff will not be negative because we will just let the options expire worthless. So the payoff is always 0 if the price is below the strike price. The concept behind the options valuation is just that we will take the payoff number here and then we look at the probability and we will calculate the probability weighted average of this payoff here. So we will get the option price of about $29. Okay, let's look at another example. What if the strike price is 180, which is somewhat higher? If we set the strike price at 180, the payoff will be 30 if the price ends at 210, and 20 if the price is 200, and 10 if the price is 190. And if the price is below the strike price, which is 180, we will get the 0 all the way here, right? So you look at the payoff here and multiply by the probability, which is very small probability that it will fall above 190s, right? Probability weighted average will be much lower than the option price of 29. If we plug into the parameters, basically we get $11. So if you look at the example here, by just imaging this picture, you will have a rough idea on the value of the options. You can do similar examples for a put options. It's just that the payoff pattern will be different here. And if you are interested, definitely we can discuss in coming videos. Okay, next let's look at one more example here. Basically, this is the template that used to do the calculation of the options valuation. Okay, in this example, I'm just plug in some random number here. Let's say the stock price is 50, the exercise price or the strike price is 40, then here is 29 days of maturity, and here I just put some dummy numbers here. So let's just focus on the value of the call options here. We all know that the intrinsic value is $10, means that we can exercise today and we can get $10. But because there is still about 1 month to maturity, of course the value of the options is higher than the $10. If we base on the formula here, we get about $12, and then that means the extrinsic value is about $2. So let's look at what happened to the options price when the price of the underlying move. So you can see that if we move to the right hand side, basically the price of the underlying will move up by 10%, 20%, and 30%. These are the price. And on the left hand side, we simulate what happened if the stock price goes down. So if you look at this, the call options is only $12. If the price of the underlying move up by 10%, the option value will move from $12.12 to $16.32. So you can just do a rough calculations here, right? Basically, the options value increased by 35% when the underlying just move up by 10%. This is known as the leverage effect. So this is why people always say that options is dangerous, because you can actually invest at a very low value, meaning you can buy a lot of call options at a very cheap price, and then whenever the price just goes up or down by 10%, then your call options will move up by as much as, let's say, like 30 to 35%. And this price here is not fixed. It really depends on all the parameters here. So imagine that if you can start with $60, right? So you can see the price move up by plus minus 10%, but the options values move up by slightly lesser at about like 26 or 27%. So next we'll look at the effect of change of the time to maturity to the value of the options. This is very similar to the previous example. It's just that instead of changing the underlying price here, I will just keep it at $50 unchanged. and then I will just change the time to maturity here just to see what's the impact to the options value. So similar to the previous example, we can see that the price of the options is $12.12. Intrinsic value is 10, and then the extrinsic value is 2.12. And because we keep the underlying price unchanged, the intrinsic value will stay the same, right? So you can see that as time changes, as we get closer to maturity here, the extrinsic value actually will become lesser and lesser. So this is why there's always cost or time decay that's associated with options. Imagine that we flip this, right? Let's say the strike price is not 40 but 60. You can buy a call options that has a strike price of 60 when the price is 50. So you can buy it at very cheap value here. Let's say here it's 3.19, right? So we hope that the price will increase above 60, and then we can have a very huge payoff. But what if the price remain unchanged, right? So you can see that from here 3.19, and then it will just keep going down, and basically by maturity, if the price still below 60, then basically these options will become worthless. So this is why to play with the options, you really need to understand the parameters. It's not just the price only, but you need to pay attention to the time to maturity, the volatility, and of course the change of the price of the underlying. I think that's all about this video. I hope that this is just a very simple introduction to options. And let's say if you are interested with some other topics that is related to options, let me know, and we can of course discuss more in the future. Okay, that's all about today's video. Hope you enjoy it. See you in the next one. Bye.